Hello everybody and welcome to this webinar where we'll be talking about the Federal Reserve's interest rate decision, the non-farm payrolls report and the potential trading opportunities that will come about as a result of both events. My name is Sasha and I'm a financial analyst from the research department at Fortrade. I'm really pleased that you're watching our webinars. If you have any questions, please call us and ask to speak to a senior account manager who will be happy to help. Before I go any further, please take a moment to read our risk warning and disclaimer. I'm sure you know that although gains can be made, trading CFDs, losses can be incurred too, and you need to be aware of this. Now, first off, we'd like to introduce you to what we call a market opportunity. A market opportunity is a one-page briefing containing market analysis, and our goal is to provide you with a simple to understand opportunity to trade on the markets. We will select an instrument such as gold or a currency pair and tell you our very best estimate on its price direction so that you can trade on it if you want to. Market opportunities are produced by the research department on a daily basis, according to market conditions and based on historical evidence. This can relate to daily trading, weekly trading, or monthly trading. A market opportunity consists of fundamental analysis, geopolitical events, and technical analysis that includes a pivot point and support and resistance levels. It's important to understand that it's solely your decision whether you trade on market opportunities or not. Here's an example of a recent market opportunity. You can see fundamental analysis on what's going on with the euro-dollar currency pair. You can see this is a downtrend opportunity over a weekly period, since our analysis suggests the euro would decline in value against the dollar. At the top, you can see some geopolitical events and fundamental analysis that can influence the euro-dollar currency pair. For example, the part on the situation in Italy, which has affected the euro. When using a market opportunity, it's vital to look at the pivot point on which the calculations are based. In this instance, if the price reaches 1.1381 that you can see on the left-hand side of the screen here, this shows the right moment in our estimation for opening a trading position, had you chosen to trade on this opportunity when it was active. You can see below the trend direction and the time period. It's also important that you know how to use the stop loss and take profit options. You have support and resistance levels here. At these points, you can put a stop loss and take profit. And on the right-hand side of the screen, you have calculations. If you close the position using take profit, you can expect these kinds of profits at the support levels in green. If the price is going against you, you can potentially have a loss of this amount at these resistance levels in red. Finally, profit and loss calculations are based on a one-lot trading volume. As we all know, the Fed, or the Federal Reserve, is the central banking system of the United States that implements monetary policy. The current chair of the FOMC and the Fed is Jerome Powell, who replaced Janet Yellen in February 2018. In fact, although Powell has been a Trump appointee, he has faced unprecedented criticism from the president, who has clearly expressed his dissatisfaction as interest rates have slowly risen. The FOMC is crucial since it's the body that makes important decisions on monetary policy by raising or lowering its target for the federal funds rate. That has a great impact on the price of the dollar. The Federal Reserve's mandate is a dual one: to keep inflation below or close to 2% and to create jobs. And it does this with monetary policy setting interest rates. You can see on this table how the Fed has kept interest rates historically low as monetary medicine to kickstart the economy following the financial crisis. But as the US and global economy has strengthened in recent years, you can see, however, the past 2 years, rates have increased to today's rate at the end of the graph of 2.5%. The non-farm payrolls report is the release of data on US jobs growth over the previous month, and it's published by the Bureau of Labor Statistics, usually on the first Friday of the month following the data. It's the most eagerly awaited monthly data by world markets. The headline number in the report gives the number of jobs that the US economy has gained or lost over the previous month. A more important number for the markets, however, is the difference between the actual change and the consensus of estimates by analysts and economists published in advance. The market reaction will depend on whether the published figure is above or below the consensus, and by how much. Over the past few years, non-farm payroll data has been very positive. Last month's figures convincingly beat expectations, as I will explain in a moment. As you can see from this chart, the unemployment rate has significantly improved in recent years. The unemployment rate approached 8.5% during the financial crisis, but has fallen ever since. The unemployment rate has dropped and is close to historic lows at its current rate of 3.9%. Average hourly earnings is important since an increase in the figures indicates a possible rise in inflation and in the value of the dollar, while a decrease in AHE tends to push the dollar down. Month on month, average hourly earnings was 0.4% in December, beating expectations. The non-farm payrolls released on January the 4th, 2018 showed that the US economy created 312,000 new jobs in December, much better than the predicted estimate of 178,000 new jobs. The unemployment rate increased from 3.7% to 3.9%. So let's take a look at how the euro-dollar reacted to the broadly positive NFP data, and then we'll go back to the Fed. As you can see on this chart, the euro-dollar dropped like a stone within hours of the release on January the 4th, as the dollar grew in value. However, the currency pair bounced back, and by the end of the trading day was only down around 0.10%. The markets welcomed the better-than-expected figures and the average hourly earnings stats, which showed that the US economy is still doing well. This pushed the dollar up, but the figures support the case for the Fed's position of up to 2 hikes this year, increasing the value of the dollar. Why then did the euro-dollar bounce back, as we can see on the chart? Well, Chairman of the Fed Powell held a speech in which he stated that the Fed would be patient and suggested that the Fed's position is flexible. This directly impacted the greenback, as traders took this to mean that there will be less hikes than previously anticipated this year. Another factor to bear in mind is that the increase in unemployment, which tends to push the value of the dollar downward later after the markets absorb positive NFP figures. The previous Federal Open Market Committee meeting took place on December the 19th. The interest rate increased from 2.25% to 2.5% in line with analysts' expectations. This hike had been signaled for some time, and the decision took into account economic indicators in the US, with Fed officials continuing to express confidence while considering indicators showing the global slowdown and its potential impact on the US. The decision to maintain interest rates was unanimous, but members indicated that the pace of rate hikes would slow in 2019. Upon the announcement of the expected decision, the euro-dollar traded slightly higher, but by the end of the trading day, the currency pair fell by 0.39, as the currency pair declined in value. The decline was triggered by the Fed policy statement, which suggested 2 rate increases would take place next year, based on the economic data that comes out and the markets absorbing the increase itself. We can see how this impacted the dollar index, which measures the currency against a basket of other currencies. Upon the announcement, the dollar was stable, and following the Fed statement, the currency grew by 0.37% by the end of the trading day. Since then, we have heard a number of policy statements from Fed Chair Powell, like the one in January, and other Fed officials who have calmed market expectations for rate hikes this year. President Trump has long been applying pressure to the Fed to freeze interest rates. He has blamed the Fed's policy for the poor recent performance of stocks towards the end of last year, which tend to increase in value when interest rates are lower, and vice versa. So what can we expect at this meeting? The US Central Bank is expected to keep interest rates at 2.25 to 2.5% when it meets on February the 1st. As you can see, there is a 95.5% probability, according to CME Group, that rates will remain at that level. Something else to bear in mind when trading dollar currency pairs is that most investors do not believe that there will be 2 hikes this year. In fact, most feel that there may be 1 rate hike at most, with some even predicting a rate cut by the end of the year, if the global slowdown negatively affects the US economy. This month's Fed interest rate decision comes as the dollar has traded in the lower ranges as more traditional safe haven instruments such as gold have climbed over the past month or so. Stocks have also come back this year. As no interest increase will take place, investors will be on the lookout for clues on movement of rates in the future. At the moment, most analysts predict 0 or 1 hike this year. So if the Fed reverts to language of its previous 2 hike position, this would boost the dollar and might put pressure on stocks. A dovish statement suggesting a wait-and-see policy, depending on data, might influence the dollar to decrease in value against other currencies. After all, the Fed fears an economic slowdown, and future data showing that the US economy is worsening means the Fed may want to halt interest rate increases. Investors remain nervous of a full trade war, and historically, US trade barriers have tended to weaken stocks, as was the case when Presidents Clinton and Obama introduced their own tariffs. Any decision to trade dollar currency pairs and stocks should be made with the geopolitical situation in mind, as well as on the direction of interest rates and NFP figures. Well, I hope that you found this webinar useful. Of course, at 4Trade, we will be following developments related to both the Fed decision and the NFP for what will be a very busy week's trading. Please get in touch with your senior account manager for further information. Until next time, goodbye, and please join us at 4Trade again soon.